Well, so, this has evolved a lot, right? So when I started this, I was convincing the CEOs and CFOs that secondaries were legal. And one of my arguments I used to make was, as the time to liquidity grew from, what used to be 5 years early in my career in a winning situation was up to 10 or 12. I said, look, it's easy for the VCs to wait 10 to 12 years, but, you've got a great person on your team who's living a life on a 10-year journey. Like, how can you expect them to do that on and just survive on their salary in California, right? And so that was the argument. I said, if you want to attract the best talent, you need to be forward thinking about secondaries. You need to lean in, and that doing secondaries is, in fact, I think the best branding event you can possibly have for a management team.
Ben Black is co-founder and managing director of Akkadian Ventures, a secondary investment firm that buys shares from employees at venture-backed companies. Most tech workers are still in a 4-year vesting schedule, but an IPO could take 12 to 15 years, assuming it happens at all. Secondary sales can provide liquidity for major life events like buying a home or paying for college, and Ben says he also sees employees use secondaries to bootstrap their own companies so they can retain more control and ownership from day one. There's a lot of myth-making about the risks founders and VCs take, but startup employees are often making the riskiest bet of all. If you're interested in understanding and potentially unlocking the value you've helped create, keep listening. I'm Walter Thompson. This is Fund, Build, Scale. Fund, Build, Scale is for anyone who's interested in learning the basic skills required to launch a startup, secure initial funding, and transform their idea into a sustainable business. Get the newsletter on Beehive or LinkedIn, and subscribe wherever you get your podcasts. And if you like what you hear, please leave a rating or review. I'm talking today with Ben Black. He's the co-founder and managing director of Akkadian Ventures. Ben, thanks very much for joining me today. I appreciate it.
Thank you, Walter. It's great to be here.
So before we dive in, can you share in your own words the disclaimer around today's conversation so listeners understand we're just talking about mechanics and patterns, not actually offering financial advice?
So, right, it's correct. We are not offering financial advice for anyone. Everything we say here is strictly educational and for educational purposes.
Can you introduce yourself and explain what Akkadian does and why secondaries became such a central part of your career?
Yeah, no problem. So I started in venture, man, now it's almost 25 years ago. Time flies. So I've been playing this game for a long time. Worked at some bigger funds, learned the ropes. And I did a seed fund in 2007, right before the great financial crisis, which lost my largest investor to the great financial crisis. And so, back in 2010, I was looking around for things to do, and I found seed investing to be quite traumatizing at that time, as you might understand. I was always the guy at Mavron when I was just a mid-level guy who was responsible for managing LP secondaries for the firm when LPs wanted to sell their stake in the Mavron funds. And so I got to know all the secondary players through that, just being that guy. So during the great financial crisis, people were really looking for liquidity, and coming out of that, it was a really, really hard time in the industry. And I ended up just doing a transaction and helping some of my friends get liquidity by selling to secondaries to institutional funds. And I said, this is a space that is really, really new and what I thought was going to be very needed. And I started my firm just at the right time, 2010. And 2011, started doing secondaries for my first fund and did great companies like DocuSign and Splunk in those years. And that sort of got my career going. And now we're a firm with about 1.2 billion under management, 7 funds, and I've been doing secondaries now for 15 years, and I've done over 750 secondaries. So I've seen every fact pattern in this space and provided an awful lot of liquidity to employees and seen how these things works out in over hundreds of examples.
I used to work in tech before switching over, becoming a journalist, and one of the things I've come to really understand from doing the podcast that I didn't understand when I was working in tech was that, investors take on risk, founders take on risk. If you go to work at a tech company, you're taking on a ton of risk. And because you're not as well capitalized as the founder or the investor, it's actually a riskier bet for you, just like going on board, like jumping into a lifeboat with
bunch of other people in this crazy idea. It's a risky, crazy thing to do, joining a startup, an early stage
Absolutely.
startup with no social signals, no proof, a vision. But
Hmm.
so with that in mind, kind of a tech career is basically it's a series of risky bets.
Hmm.
And
Right.
I think in my looking back on my own experience, I didn't do a great job of evaluating, doing due
Hmm.
diligence about liquidity, especially before joining up. And so I guess with all that in mind, what should an employee actually ask a CEO or a CFO before they accept an offer about secondary policies?
Well, so, this has evolved a lot, right? So when I started this, I was convincing the CEOs and CFOs that secondaries were legal. And one of my arguments I used to make was, as the time to liquidity grew from, what used to be 5 years early in my career in a winning situation was up to 10 or 12. I said, look, it's easy for the VCs to wait 10 to 12 years, but, you've got a great person on your team who's living a life on a 10-year journey. Like, how can you expect them to do that on and just survive on their salary in California, right? And so that was the argument. I said, if you want to attract the best talent, you need to be forward thinking about secondaries. You need to lean in, and that doing secondaries is, in fact, I think the best branding event you can possibly have for a management team. And of course, that view, despite the fact that the VCs hated secondaries at the time, they hated the idea of employees getting liquid. That view won the day because now secondaries are a core part of the ecosystem,
Mm,
and it's much more. I mean, for employees today, you know, the vast majority of really good companies now have secondary programs. There are still companies that have it all locked down that don't allow any transactions to happen. And I do think that employees should investigate the founders, attitude towards secondary if there is success. But this is because if you're not allowed to sell and you're working at a company for 5 years, even if the company is doing great, it's like a 12 to 15 year journey to get liquidity. And so trying to get into that mindset is something that you can get into, in early on, just like asking the attitude, like, what do you think of secondaries? Like, is this something if you're successful, that you'd want to be proactive about? Great companies like Stripe now, they're super institutional, and the secondaries are just like part of being an employee. Is you're going to get to participate in secondary liquidity on a regular basis.
mm.
SpaceX, the same thing. So there's a lot less. I mean, I think you're going to find it much more rare that you're going to find a manager or a founder who is hostile to secondaries. But boy, you want to know that up front. If there's like a big, attitude about that, and there are some companies where the founders they just hate the idea of anyone selling early, and I would put that into your employment decision, and I would stay away from those companies because no matter how hot something is, I think one thing that people don't realize, even when they're in joining companies midstream at sort of the growth stage, how many things have to go right now for a company to get liquidity.
Mm.
We see a whole ocean. There's like $3.6 trillion of stuck equity in unicorns right now, and the vast majority of that is never going to turn to cash. So I think it's something that you should be highly aware of, and that's something that you should really try to understand as early as you can.
I'm kind of curious among the investors you talk to, VC level, is it kind of like something that they've accepted grudgingly
Yeah.
because it's just kind of like they realize like you need to be competitive, or
Well,
what are they?
they've come full circle. So now I would say a very significant part of the returns of the large funds is in fact comes from secondaries. So, it used to be that, that VCs were limited in how many secondaries they could buy, but the big funds have become RIAs, and they are very happy to buy employees out, as part of rounds and get us get all the shares they can. I mean, obviously you have to have a winner. Um, I do think that there's the mistake, people don't understand today, however, even at the growth stage, how concentrated these liquid secondary markets are. So roughly 75% of the secondary market, it happens in 20 companies. If you're not at one of those companies, then you have to be much more skilled in how you create liquidity for yourself. And that's most employees. So, company choice and understanding where your company fits in that, in how desirable that company is going to be, is, I think, a really important part of the due diligence process that any employee undergoes.
So most companies are still on a 4-year vesting cliff.
Most companies, as far as I've seen, most companies are a 4-year vesting cliff. I think that's never changed. That's cultural. And most companies will allow, when there is secondary liquidity opportunities, they'll allow, their employees to participate in them. If you want to get, and that's typically like sort of the vast majority of that sort of Series D and later. So if you're coming in Series A, and you want to try to get liquidity in Series B or Series C, you're going to have to be pretty strategic about how you make that happen. And that's where your own knowledge as the employee and your own proactive behavior can be the difference between, getting liquid and not getting liquid.
I mean, I'm curious about that 4-year cliff though, because it seems like a vestigial, it's an artifact from an earlier time when people would reliably go public or something.
Mm.
Do you think that's ever going to shift, or are we just kind of locked into that for good?
Boy, I have not seen a shift on that at all. If it is, that would be news to me. My sense is that there's a tremendous amount of job hopping as it is, and my sense is a 4-year for a mid-level employee, like a 4-year path at a company is it's pretty rare that you make it all 4 years, typically before you jump to something else. And that's another thing you should be thinking about is when's the right time to leave, right? Because every employee should be thinking about their own career as a series of bets that they're making with their time. And you think like a VC, and I think that it's important for employees to be assessing the likelihood of a good outcome, on an ongoing basis. You got to be, no one's protecting your career but you, and the team. If you're good, they're going to want to keep you there, and they want to give you as little as possible. And got to know how to play the game.
I mean, and they're also going to whisper sweet nothings into your ear about how great this company is and how well poised it is for success, and
Yeah, and boy, we always would know, whether an employee was valued by how they were treated at their 4-year cliff, because with the best employees, a lot of our best relationships, like companies like DocuSign, where we're very much sort of engaged in a lot of their employees and helping them get liquid. They were very proactive. Like when somebody hit a 4-year cliff, not only did they give them their big new grant to keep them, but they would literally bring me in and be like, Ben, I want you to buy X amount of stock from this person, so that they get to taste some of the value of liquidity at that point. And if you want to know what they think about you, like if you're really an A player, like that's the way it should go, right? Like, and if they're not re-upping you and allowing you to sell some, then you kind of know that you're not as valued as you think.
that's a good tell. How he's just not that into you. Talking about the
He's
CEO.
just not that into you.
It's funny.
Yeah.
All right, so let's get into the mechanics a little bit. I've been at company X for a full year. I've vested 25%. Assuming it's an option, what are some exact steps I could take to exercise early, avoid some short-term capital gains, and maybe keep optionality later?
Well, let's like at the early stages, you can do 83B elections. So that gets you a bunch of tax benefits on your later option exercise. I don't remember all of them, so I don't want to pretend to be an expert here,
Sure.
but I know that's a standard thing. It's very easy to exercise your options, and obviously you really want to if you are a believer that this is a winner, because it reduces your tax bill. When you exercise your options, you got to come up with after-tax cash to go do that. And you're going to exercise your options, and you're going to pay a tax on the difference between the price of your option and the fair market value at the point in time when you exercise. And the longer you wait, the bigger and bigger that tax bill becomes. And it gets to be, it can be incredibly onerous. And this is a huge problem that people will face in very successful companies about how do I even get the cash to exercise. Now, those types of people, there are firms that do option exercise loans. We used to do them. We don't do them really anymore. That used to be about 30% of our business. For a long time, it was a really good way for us to get exposure, because we would loan people the money to exercise their options, and then we would buy a call right so that we could buy a percentage of their shares that we would pre-negotiate at the price of the stock at the time of the loan. And that would enable the employee, we would have the right to exercise that option after a year. That meant that they were financing their own options exercise with our cash, which is a big benefit, but they're also getting long-term capital gains when they do sell us the stock. Because you got to remember, when you exercise your option, you then own it. You have to own it for a year before you can get long-term capital gains.
Mhm.
Now, so there are other firms, out there that do that. I'm not up at really who's doing it on the marketplace. I know Equity B is one place that funds option exercise loans. That's the one that comes to the top. There's another firm, I'm just blanking on the name. I think a firm called Quid will do it. But I know that there's a family of firms that still, do those deals. Uh, and so you just want to do some research and find out who they are.
How many people are kind of just leaving money on the table, like walking away from unexercised options because
Oh,
they don't have an option for they don't have ready cash for,
it happens all the time, right? So the cruelest part of this business, I think, is the 90-day. You have 90 days to exercise your options after you leave, and
Yeah.
that is driven by the tax rules, not companies. Companies can uh, extend that and enable you to extend those options later, but there's a much bigger tax hit if that happens, and the company's taking on some issues there as well that they have to be willing to do. But I see this. I mean, I just get hit by people all the time with large positions in companies that aren't really financeable. And so, for example, today, one would say like you joined a company at 10 million of revenue and it's doing 100 million of revenue. You would hope that that would be valuable. But if that company is only growing 10-20% today, 20%, like it's not really a transaction that people like me or other secondary buyers are necessarily going to be interested in that, or if they are, they're going to be interested in a price that's pretty onerous. And that point is going to be you can just sort of face some really difficult choices, and that's endemic to the game, I'm afraid.
One of the things I know is that employees, line employees are very heads down, very focused on their work. And so they're not watching the market. They're not thinking about externalities that could make their company more or less valuable.
Mm-hmm.
How do you, if you are one of those, line workers just getting your thing done, how do you get a sense of when it's the right time to sell?
Well, this is a topic that is near and dear to my heart because I've been through doing this for a long time, and this is one of the hardest psychological issues that people have to sell when people have to sell. So I actually give like long conversations with this with other VCs about when they should sell. And here's what I want you, if you take one thing away from this podcast, it's this. You want to sell something substantial at the time when it feels like the company is on fire and is unstoppable. And the psychological problem that you're going to face is you're going to start dreaming about what if the stock is worth 2, 3, 4, 10 times what it is today. I'm telling you, at that point, when you feel the safest, when you feel like it's crazy to sell, that is exactly the time you should take something off the table. Because people at companies, from CEOs on down, constantly overestimate their ability to keep the success going. All right. So if you're in a company that's growing 100% a year and you did it 2 years in a row, you have a chance to sell something, you should absolutely sell something, because the chances that there's going to be a change in the market, a new company is going to come out, you're going to have a scandal at your company. There's 1,000 reasons why that success will not continue. And that moment will be lost, and it will be lost forever. I personally have made something like, I think, 50 sell decisions or something like that. I have sold companies too early, but I more regret the companies I didn't sell than the companies I did. There's way less examples where that company went on to achieve some incredible outcome. Keep something back, but sell a third, sell a half, sell something to make those years that you worked worth it. So if everything goes to hell, you don't regret it, because missing that moment can be the most painful thing. And you can lie in bed, and everyone's done this, lie in bed at night, beating yourself up that you didn't take that opportunity. So when things are the safest, that is the moment when you should be like, I need some liquidity now.
I'm starting to wonder. So employees who are getting into the secondary market, do they have to face some sort of cognitive dissonance? Because it seems almost like they're betting against the company on some level, based on what
But
you just
yeah,
said.
I think that there is. I think the difference between people who are successful at this game and people who ultimately aren't is the issue of like, you're not betting against the company. You're getting paid for what you're created. Reframe it, right? You are saying you've created this value that exists today.
Mhm.
How many companies do we know that were, I mean, we just went through this, like everyone just learned this so painfully. Like the companies that were hot in 2021 are not hot anymore. All
No.
right.
Yeah.
And in fact, there are very few companies that will survive that 2021 shift and create great outcomes for their employees. In 2021, they all felt like they were literally on top of the world. And then an AI, AI hit ChatGPT, one product changes the entire ecosystem and where all the money is flowing. And all those SaaS businesses that were cranking, growing 70% in 2021, they're all growing 10% now. And there's just sunk equity that will never be valuable to anyone. And you're sitting behind a huge pref stack of capital. And that's something that people just, you can't foresee that. Like no one foresaw what AI would do to the late stage market in the secondary market, but it destroyed the secondary market for so many companies. And there's just tons of companies out there that are trading for 80% discounts now, if they trade at all. And so that's why I say, like, when things are the best, you're not betting against the company. You're getting paid for what you created. And when you have a chance to get paid, get paid.
Words to live by. Let's talk about how employees actually get liquid. And I guess maybe step one is kind of getting access to these like insider-led liquidity events. Is that kind of
Yeah.
okay?
Yeah. Well, yeah, absolutely. I mean, that's going to be the largest, percentage of, if you think about just like the percentage of employees that get liquid, will get liquid through structured programs. And the structured programs means that you're at a winner. You're at a company that's going to be in the top, call it 50 companies.
Mhm.
If you're not at one of those companies, then you have to be, and you don't have these structured liquidity events, then you have to be more thoughtful and more proactive about how you get liquidity. Um, the first step there is you just want to go, if you want to get liquid and you know that there's a round coming up, the most important thing to do if there's nothing structured for employees is go to the founder or the CFO and say, hey, look, if this round goes well, I'd be up for selling some of my stock. And that is a conversation that they're going to expect. It's not going to be surprising. It's not unreasonable.
Mhm.
And then you can say, I'm not planning to leave. You can say that. But just to know, if the round is oversubscribed, I'd be happy to participate in any secondary that comes together, right? And that's, that is just puts you ahead of the line. Means that they know maybe they, for whatever reasons, they don't want to do a broad-based thing. That happens all the time. They don't know, a lot of firms, they won't want to have a bunch of secondary that they sort of explicitly shop, because again, that sort of is a negative signal potentially for some. They may worry it's a negative signal. And if that's happening, being proactive and putting yourself at the front of the line can really help. I've seen it work many, many times. And so, because then they just know who to go to, they don't have to manage a structured program. Because, it is a hassle for them to do a structured program. So if you
Mhm.
just, a lot of these things happen informally, people will be like, oh, I've got, one of our companies, the CFO does this all the time. He just, says, hey, look, these guys just reached out to me, are you interested? And a lot of times just that proactivity is what will get your stock sold. And there's just nothing wrong with it. There's nothing to be afraid of. A good team should expect it. Yeah.
If you were putting yourself in that person's shoes, would you go in solo or would you talk to a coworker first and try to like maybe kind of do a bit of a
You know, I don't think that you necessarily, so there, if you, I would just go in solo at the beginning. I don't think that it's anyone else's business. And I think that I think that being quiet about it is the more professional route. Um, you know, I think that the time to go to coworkers is if the company, there's a subset of companies that don't proactively help employees get liquid,
Mhm.
but when faced with a transaction, will allow it. And this you got to kind of suss out. And this more happens between rounds. Let's say in a company, especially if the company's profitable. Like once a company is profitable, they're not doing new rounds. They don't want to raise more capital. but the company's profitable, it's doing well, it's very healthy. At that point, you can go to the CFO and say, hey, I'd like to, go see if I can find a buyer for my stock. If the company's not hostile to it, and you can still sell times if the company's hostile. Sometimes you can make things happen anyway. We'll get to that next. But if the company's not hostile to it, the bigger the transaction you can organize, the more interesting it's going to be for a larger set of buyers. And so if you can go out there and say, look, I've got 10 people that want to sell, and it's a $5 million transaction, $500,000 a piece, then I think that's a big enough deal that you're going to attract enough potential buyer to get your deal done. I think in that case, and then you have to kind of have an organized structure. Then there's the issue of how you use information. That becomes the trickiest part of all secondaries, is like, what information can you use as part of the process? Really proactive, well-organized employees will organize their own rounds, and they'll get the company to say, you can use our information. Here's a very basic data room, just like the corporate docs and financial statements. And then you can go shop that deal in a way that's really, really beneficial for you, if you can do it, if you can pull it off. That takes some sophisticated work, and that's some sophisticated conversations. The best way to get those done in that circumstance is to take the 10 people, we're going to agree on a price, and get the companies aligned with it, and give them a list, and be like, I'm not just going to go shop this to anyone. I'm going to talk to these 5 firms, or I'm going to talk to I want to talk to the insiders, because a lot of times they're the best buyers. But I'm not going to make it work for you. I'm going to do this all yourself, because this is, the company's got no dog in the stick, particularly between rounds. Like, it's just an annoyance. So doing it, showing them that you're going to do it in a highly professional way, where you're going to have potential buyers sign NDAs, it's a limited list. The buyers are institutional. They're not just some high net worth individual, is going to give the company comfort. And I see, and usually these are people who are pretty high up that make these deals happen. They're much harder for sort of lower level, sort of mid-level employees. But usually in that case, if you could say, I'm going to do all the work, you can get the company to go along with it. Now the question is, what do you do then? Well, then there are brokers out there. The best way to do it is to go to brokers. For bigger deals, like I love this guy, Nader Ashfar from Bastiat Partners, who I think in LA, he's very, very good at these. Hive, I think, has done a very, very good job of sort of productizing their offering, and they really, really hustle. And the more information you can get, the more likely you is to get a deal done. Now, if you're a super hot company, like it's Cursor or something, that's just like a rocket ship, you can probably get deals done with no information, and that's different. To use case, your job is a lot easier in that case. Now in those cases, the company's going to have a right of first refusal on these shares, right?
Mm-hmm.
So basically, the insiders get a chance to buy it at whatever price is covering, and that's going to limit your group of buyers. The really sophisticated move, if you have a lot of leverage for whatever reason, is to get the company to waive its ROFR, waive its right of first refusal, because then all the guys like me will jump all over it, because we know if we do buy the deal, we're going to get it. Because it sucks when we go out, and typically I won't work on anything where the ROFR is not removed. I just don't, because it's a waste of time. Why do I want to price something for the insiders? So that's now we're getting to a pretty sophisticated move.
So the platforms like Hive and AngelList, the equities, and they're pretty self-serve. It sounds like you're talking about going off book a little bit, like this would acquire a lawyer or someone actually.
Well, yeah, you don't necessarily need a lawyer, because we'll bring lawyers, but these transactions there's just not a lot to them legally from that perspective. You're going to use the company's transfer agreement. There's a process. You just have to get a deal submitted to the company. You can go to Hive, and there's like lots of those deals, and those are in very hot companies. Those work great. You're not going to get very good pricing if you go in and just put a little deal onto Hive that has no information. Now, there's a lot of ankle biters out there that will buy it, but your pricing is going to be a lot worse, like substantially worse. So if you want to maximize the value of your deal, you run a process with information. That's really going to do you a lot better. Now, some employees don't have the ability to do that. There's nothing wrong just going to Akkadian or going to Forge or any of the platforms, I think that Hive is doing a great job these days. So, I would probably recommend Hive first. But you know, that's not going to get you the best outcome. Because there's a bunch of firms that just sit there and low ball, but it depends how much you need the money, right?
Mhm.
In that case.
So, what are some of the non-obvious constraints an employee wouldn't be aware of until they went out into the market and got into the process?
Well, I mean, I think the hardest thing to deal with was without doubt the information. And you're as an employee, your reputation is everything. And I do see a lot of bad behavior among employees, which are using information that they're not supposed to use. I think it's very risky. And you know, you can really, really piss off the company by doing that, like really piss off. So if you go that route where you're giving non-public information to the secondary markets to use to get your transaction done, you are taking a risk, and you are taking a risk that you could really poison the well. And what that means for your career is up to you for assess. And some people need the money and they do it anyway. But that is probably the most important, non-obvious fact is like how some people go out without doing their due diligence, without really talking to the company. And then they're very surprised when the company behaves in a very hostile way. And that is something I would really avoid. But otherwise, like, look, you can go post your shares, and the companies, a lot of companies just have a kind of hands-off attitude. And, believe me, a big part of the services we provide when we're inside of companies, everything we're doing is with the approval of the company. We're working in concert. We'll just take shares off of off of the platforms because an employee doesn't go to the CFO.
Mhm.
They just go post something. And then we see it on Hive, and I'm like, boom, I'll buy that tomorrow. And a lot of times we'll have a ROFR, so we'll see the deals come through Hive Representative. We take the shares because we'll have the ROFR. But like we're all big boys now. This is a huge market. Like everyone sort of knows the rules of the game. But the biggest, not obvious thing is that using that information you shouldn't, and how that can blow up in your face.
What does a healthy CFO employee relationship look like around secondaries? And I ask because, again, like, small stage startups, everyone's kind of in the same, bucket as far as like, but culturally, you don't really interact with the CFO very much because,
Yeah,
you're doing product stuff and they're over there doing financial stuff.
yeah,
So how do you make that work when, you're not really on the same side of the organization?
yeah. Well, I mean, look, relationships are everything, right? So just making an effort to get to know them, um, making the effort to understand how they view secondaries in a general fashion, because it is an awkward topic for the managers and CFOs. Like I've just worked with so many different CFOs who handle this in very different ways. Understanding that allowing you to sell does create internal issues about how many other people do they have to allow to sell, right? Um, so being circumspect, understanding their position ahead of time, that's really the best you can do, right? And be respectful of what the attitude is. Now, oh, excuse me. Um, that is, that's where you just really need to have a lot of EQ. The more they trust you, the more likely that they are willing to let you, go off and try to organize something, which is really the way to get the best outcome. And, by showing them that you've really thought the issues through and that you've studied it and you understand it from their perspective, that you understand their need for confidentiality, you understand their need for confidentiality within the company, that you need to want this done quietly. That is issues like, companies don't love seeing their shares put up for super cheap prices and that creates like optics for them. And to the extent that I think that to the extent that you can protect them from that happening, you're gonna find a much more willing partner in this. But making the CFO your partner is really important in these kinds of situations.
Can you share some examples of employees like using secondaries to, buy a home or
Well,
pay off college loans or cover
yeah,
childcare, like an elderly parent? Like there's all kinds of crazy things that'll come up that, we can't ever predict.
yeah.
So like what are some of those real world like use
So
cases?
I look, we've invested $1 billion in secondaries. Okay, I've never gone back and be able to look at like what the purpose of those proceeds were, but I've often joked that I raise capital from investors that goes directly into San Francisco real estate. Okay. The single biggest reason why people do secondaries is to get a down payment on the house in the Bay Area. Like that's the biggest reason. In fact, true story, I had one CEO, a founder of one of the companies who was actually really cool about like letting their employees sell. He was very open about it and just really let anyone sell at any time. Very rare. But he said to me, there's no way that I would sell one share of this company. Like I just am such a believer in the future of it. But if other people want to sell, that's their business. Like I'm their partner in life and I want to make their dreams happen too. But I would never sell a share. 2 months later, I get a phone call and the CEO says, man, you're not going to believe this, but where I live, I've lived there my whole life. It's in a very expensive California coastal town. And he said, this house I've just dreamed about owning for my entire life just went on the market and I need $6 million. And I said, you got $6 million in 3 days, no problem. And, he's very happy that he did that. And, hopefully that company's still still going. So I don't know how it's going to work out for us, but I think pretty good. And that's a win-win-win all around. But houses, college educations, and I think that when you have a good reason, that you will, if you share that with the founder or the CFO, like they're going to be more understanding, right? Like, so I would lead with that. And talk about like the non-obvious things to do. Like, hey, look, I got 3 kids with ages 14 to 16. I got three college educations coming up. Like that's a really good reason to sell.
Mm-hmm.
And I guess I should have said that on a non-obvious point, but that's a really good way to frame it. But the vast majority of non-founder liquidity is driven by that. The other unfortunate one that gets very messy is a divorce. So when you have a stock option in a company, that becomes a marital asset, right? And that becomes a very tricky negotiation in the process of divorce. And I've gotten multiple deals that have happened in the context of divorces, and pretty much it's one spouse not wanting to sell and the other spouse demanding to sell, and that is awkward. One of my best deals I ever did was a woman who was employee number 4 at a hugely successful company, and she had married a guy who had a lot of problems, and she wanted to get rid of him before her stock became incredibly valuable, and she did. And we went in and bought him out. He had never seen that much money in his life, and he thought it made the whole divorce go super easy. And we made it 6 times our money in 18 months, and it was an amazing deal for everyone. And she sold some too. Actually, she went and bought a Ferrari with it, which I questioned at the time. but
sounds
like
very, very post-divorce
yeah,
behavior, kind of a.
Green Ferrari, which I was like, you didn't even get a red one. Like, this is just strange. But ultimately, she ended up making $60 million from her stock, and it didn't matter at all to her. So because it was just a small part of what she had. So that is a naughty situation, but it certainly does happen. Health issues also are an issue that can take a situation where you can't sell, where the CEO is just like, hey, look, I know we don't let secondaries happen, but this is a special situation, and that is also something where I've seen very restrictive companies make exceptions.
Well, avoiding catastrophic mistakes sounds like the main thing here, because it's like this is probably someone's main source of wealth they're probably ever going to have in their entire life. What are some of those? I mean, there's so many different things you can get burned by, like as far as just timing, taxes, mispricing, even just assuming that the liquidity will exist later. What are the top, like, let's just say 3 preventable mistakes that you wish everyone understood before?
I think that the biggest preventable one is staying at things that aren't working too long. When your job is to be an employee, not a major owner of the company, the best employees, of course, are really hard workers, and we want to talk about loyalty, but you really have to question, when you're in this business, how long you stay at your losers, because, and you have to be really, I think, skeptical, and I think you need to take a lot of a lot of shots on goal. Like VCs have portfolios, typically 30 companies. Let's go to standard portfolio size, right? Like, and in that, they're going to have one winner, right? And you face those same odds. So creating a lot of shots on goal for yourself is, I think, a really important thing to do. I think that the people that I've seen that played this game most sophisticated, with most sophistication around this, are maniacal about creating lots of opportunities. And this is, by the way, against the ethos of what the companies want. They want people to come work and stay forever. But if you're talking about winning at this game, the people that do it the best, they'll work at a company for a while, they'll sell a little of the stock that when they vested, more majority of their stock, then they'll go off and they'll start working with like 5 companies as like consultants or advisors. And they'll spread their bets, seeing which one of these companies is going to sort of really take off.
Mhm.
And then once they feel like they have a winner, they'll jump into that company and negotiate a really good package. That's a way that people that really play this game well operate as sort of a standard, So if you're a great VP of sales, or a great, that's a great example, like really good VP of sales, you don't really know how good the product, how hard to sell a product unless you've sort of seen it for a while. And those guys will become like advisors in coaching people and things like that to get insight. Another, I think, not obvious place is that, like, within functional disciplines, I think that talking to a lot of recruiters can be really useful in terms of, like, really getting like the inside. Like, if you're being recruited by one company, talk to a recruiter about the competition, right? And see it from their recruiter's eyes. Like, where are people going? Are they excited that they're doing well? And getting that perspective and doing a lot of due diligence on the company and the opportunity and behaving like a VC. Like, you are got to underwrite that company yourself, and you have to be maniacal about underwriting it because you have a limited career with limited number of shots on goal. And so, being really deep and thoughtful and like finding those really unique sources of data, like especially in the sales group, I've seen some, like, I talk to recruiters when I'm doing enterprise deals because, like, they really know what's going on at these companies, right? And they have great perspective because they're moving people all over the place, right?
Mhm.
And they know where salespeople are like hitting their goals, right? So getting that kind of data and not just relying on the company and what, your biggest danger is a really great CEO because they will sell you on anything. CEOs are reality distortion fields, so don't just rely on what they tell you. Another thing you can do that I think is really interesting is like this: go approach former employees. Why did you leave? You can find people on LinkedIn, and if you reach out to 10 of them, maybe 2 of them talk to you,
Mhm.
and really get the inside scoop, because each decision is like that. And then the other thing people mistake is not really understanding the value of their equity, right? So when you get 100,000 shares, if you can't tell me how many shares there are at the company and what the capitalization structure is and what the rights and preferences are of the preferred stock, you have no idea the value of what you're getting.
Got
So,
it.
you have to go and really make sure you get that information. And if they fight you on understanding the cap table,
Sounds
that's
like
a
that's a red
really
flag.
negative
Yeah.
sign, because I would like to ever remind us, the structure of all cap tables are public. You are required to go to Delaware and submit your articles of incorporation that defines your capital structure. So the idea that these, you don't need the like detailed cap table of everyone's on it, but just a summary cap table. If they don't give that to you, I would run screaming for the hills. So, that'd be probably the things that I would be thinking about if I was an employee.
This is very, I mean, this is all super tactical advice, but it all seems like it's kind of like, I think I touched on this earlier. It's kind of culturally, it's a bit at odds with the all-in culture that they try to
Mhm.
really instill. Like, if
Right.
they indoctrinate people at these small stage startups, and we're
Mhm.
all, the whole 996 workplace and the hacker houses, and it's a belief system. It's not just a work. It's a
Right.
lifestyle. And
Right.
so this is like creating this kernel of skepticism and keeping it inside yourself as
Inside
you're
your head.
doing these jobs. That's a lot of work.
Who has created that culture?
Investors.
Founders and
Yeah.
investors,
Yeah.
right? So they're selling you a dream that rarely happens. So, we had, at best 15 IPOs last year of any significant import.
Yeah.
the IPO dream is gone, essentially, and I just don't. I'm more skeptical than most, but given the performance of the IPOs last year and the complete lack for the last 3 years, and the incredible backup, secondaries are your way that you're going to get liquid. Like, and so you have to be skeptical, and you have to advocate for yourself. Nobody is going to take care of you. Nobody.
We've got a little bit of time remaining, and I really want to talk about how listeners could possibly use secondaries that bootstrap their own company. But I just want to do a kind of a fit check as far as whether that's even realistic. So theoretically, somebody who's at, mid-career, they're at a company like Stripe or a
Mm-hmm.
SpaceX caliber company, they're sitting on meaningful equity, they don't have, friends and family runway, but they have an
Mm-hmm.
idea for something and they want to execute. Would it, generally speaking, would it actually be possible to use secondary liquidity to fund that first 12 to 18 months of runway?
I see it all the time. I see it all the time, and particularly, I think it's something that's done by the more jaundiced, cynical groups who say, you know, I want to own my own. I think that the creation of businesses for just operating businesses that fund a great life and can create a 20 or 30 or $50 million exit when you own all of it is the most underrated thing that the system doesn't tell you is totally possible, right? You're going to go out and get seed investors. Once you go out and raise venture capital, you're on their boat. You have to build this thing to their needs, which is this
Mhm.
huge outcome. I know so many people who have sold equity in something mature, and gone and created their own businesses that have been extremely successful. It's very, very doable, and in fact, highly laudable. I think that VC is incredibly overrated. I think the system is designed for VCs, and that, we're captured by these stories of the incredible wealth created. I mean, I think it's you're much better off. Most people are going to be much better off if they can get a job in big tech that's sizable, than go in the startup land. And
Mhm.
if you're going to go the startup land, you should be cynical and be an owner and own as much as you can, and not just work for other people. I think it's a great use for secondaries, if you're ambitious and you have a vision for that. It's
So,
very
okay.
doable. Yeah.
So what makes someone a good candidate for this? What are the circumstances that need to be true for, like,
Well,
is it company quality? Is it the share type? I mean, I know it's a lot of different things, but what are some of the vesting schedule? What are the
Well,
tells
yeah,
that
I don't think that that's really, look, if you're lucky enough, you gave the examples of SpaceX and, like those folks, people who have been successful and they have some equity have no problem getting liquid at those companies. Um, that's the most important factor. And then the rest of it's just your ability to start a company and your ability to take the risk with your own capital. The startup game is not for everyone. And I think that people that have been successful at some of these big companies do overestimate their own ability to go start their own thing. I see that all the time.
Mhm.
But I've also seen many successes. So I don't think it's anything to do with the fact pattern. Really just has to do with, do you have something you can sell? Are you able to sell it? And do you want to reinvest it in yourself? I think that is a fantastic thing to do. And I think that it's available to anyone with the vision and the grit to do it. There's nothing specific or technical about the people. Like, the cash is the cash. You can do whatever you want for it. The question is, can you get it? And do you have the cojones to go and invest it in yourself?
Mhm.
And I think if you have it, then I mean, it's a very, I think, viable path, and I've seen many, many people do it. So like I think it's as simple as that.
What does the timeline look like as far as, like, it's Tuesday afternoon, I have an idea, I go talk to somebody who, I'll buy your shares. How long from that Tuesday afternoon conversation to me actually getting a check in my hot little hand?
Well, it depends again on the situation, but in one of these highly liquid, companies, you're going to, if it's if you're at the company like Anduril or Anthropic, you could put your shares up; they'll be gone instantly. And then you're going to run through the 30-day process where the company has the right to exercise their uh, um, their right of first refusal, and then you're talking about 30-day wait to get your check. Um, where there's no right of first refusal, these deals are very simple, and you can be done in 5 days if it's really in demand and the buyer really wants to move. Um, if you have to create a process, then you're talking at months. Months. So you got to deal with the company. You got to do it. Okay. You got to go find buyers, like that's like months of time. Then you have to run the ROFR process, right? So, I mean, like, there are people hunting the best of the best, but I think that's not the situation most people are in. Most people are in right now. Most people are holding equity in, companies that where it's not clear if they're secondary market or not. And this, I should add, actually, this is a really good point. How do you find out if your company is one of the companies that is, where secondary is possible? There are markets now. There's obviously EquityZen and Hive, and you can go sign in just like you're a buyer, and and you can go look and see, how many transactions were done through the system. So like Caplight is a broker system that we use, and that has a pretty good view of all the companies that are getting done. Like, where are their deals? So you can find somebody who's got access to one of those. But if you just talk to the brokers at Hive, or you talk to the brokers at EquityZen, they're going to tell you sort of what the market is. They're going to have a pretty good sense of what's possible.
I guess my last question for you, for anybody who's listening who still feels intimidated by this stuff, what's the simplest first tactical step they could take tomorrow to better understand their equity and their options?
I think the first thing you should do is understand what the value is, right? I mean, so the first thing you need to do is look at what your option exercise price is. You need to find out so remember, like, you started the company 4 years ago. Do you know how many shares have been issued since then? Do you know how the option pool has been expanded? So the first thing to do is understand the value of what you have. So the simplest thing to do is to go, get the current capital structure, shares outstanding from the CFO, and look to see where the value of the last round was at, and then look at your option grant about how many shares invested and do the math about what your position is worth. That's the first thing you got to do.
Awesome. Ben, this has been a super tactical conversation. I really appreciate the time. Thanks very much.
Great. Thank you.
The Fund Build Scale theme was written by Michael Tritter and performed by Michael and Carlos Chairez. Michael also composed Ocean, the track you heard at the top. If you enjoyed the episode, please subscribe and leave a rating. It helps more people find the show. You can get the Fund Build Scale newsletter on Beehive, follow along on Instagram, and if you have a guest suggestion or a question, reach me at fundbuildscale@gmail.com. Thanks for listening. Fund Build Scale is a production of Truth and Soul Media, LLC.